silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist.
The past week has been a banner one in the precious metals markets. Gold has been pushing to fresh highs. Spot gold now trades around $3,646 to $3,650 per ounce, up nearly 1.8% this week, as investors increasingly price in U.S. interest rate cuts and react to softer labor market data. Silver, meanwhile, is trading in the low 40s dollars per ounce, roughly $41.50 to $42.50, holding steady, but still beneath its most psychologically significant resistance levels. Schiff believes the precious metals cycle is no longer nascent, it's accelerating. His predictions are especially super bullish for silver, which he sees as poised to explode once certain resistance levels are decisively broken. But his bullishness doesn't exist in a vacuum. He ties it directly to what he judges to be weakening fundamentals in the U.S. economy, unstable monetary and fiscal policy, and a lagging labor market masked by overly optimistic official statistics. In the first segment of today's interview, Schiff walks us through his view that silver's breakout above $50 would act like a spring-loaded release. Once that happens, he believes, the price could double to $100 within months, citing overhead resistance, short positions, and minimal supply cushion above that threshold. In the second segment, he shifts gear and frames his broader thesis. Gold is entering a new leg of the bull market, driven by systemic economic weakness, inflationary pressures, and the possibility that central banks, especially foreign ones, are positioning themselves to move away from US dollars and toward gold as a reserve asset. By the end of this video, you'll hear the concrete data and arguments Schiff uses to underpin these claims, and you'll be able to judge for yourself how realistic his targets might be, including what gold might do if a US sovereign debt or a dollar crisis unfolds. If you're tracking metals, inflation, or the interplay of central bank policy and commodities, this one's for you. If you like deep, data-driven outlooks like this, hit that like button, subscribe, and ring the bell so you'll know when we drop more interviews and analysis. Now, let's dive in and hear what Schiff has to say.
I think this cycle really just got started after that consolidation, but I think the leg started in 2024 when we broke above 2,000, and we quietly moved from 2,000 to 3,000, and nobody noticed it. In fact, when gold was hanging out at 2,000, a lot of analysts put sell recommendations on Newmont and Barrick because they thought that gold had topped and they didn't see any upside. And then I think when Trump won, a lot of people expected the gold to fall because the economy was going to boom and Trump was going to do all this great stuff about shrinking the deficit, making America great again. But now it's becoming more obvious that none of that was true. But I think this is a new leg. We spent really over 10 years. Remember, the first leg of the bull market was 2001 to 2011. Gold went from under 300 to 1,900. So it increased by sixfold, right? Then it really went sideways from 2011 to 2024. Gold traded between 2,000 and maybe 1,500, 1,700. I mean, it initially pulled back to 1,000. It got to 1,050 in 2015. So it held 1,000, went back up, but only made a new high briefly during the 2020 COVID crisis. It poked its head above 2,000, but then, it got chopped off and it went back down. But that's a huge base that we built around 2,000 as a floor now, because it was resistance. It was the ceiling. Now it's the support. And now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1,900 consolidation. That was a sixfold increase. If you assume we go up sixfold from 2,000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. And I think that there's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. And in fact, following the weak jobs report that we got today, and by the way, the jobs market has never been this weak outside of a recession. In fact, the last two times you had a labor market as weak as the one we got right now, it was the Great Recession of 2008, 2009 with the financial crisis, or 2020 as we were shutting the whole economy down because of COVID. So, the Fed has been mischaracterizing this labor market. Powell kept saying we have a really strong labor market. We have a really strong market. He was wrong the entire time. We have a weak labor market. And you would even see how much weaker it was if we had honest statistics. But we don't. But even with the statistics we have, we had outright job decline in June. We lost 13,000 jobs in June. The August number was just plus 22,000. Manufacturing lost 13,000. And the U6 unemployment rate, which is more relevant than the headline rate of 4.3, is 8.1. So we've got rising unemployment and inflation. The Fed said that the labor market was strong, but inflation is weak. They got it backwards. The labor market is weak. Inflation is strong. And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad, and we got a long way to go. But, the whole time that gold was going sideways for 3 or 4 months, gold stocks were quietly going up. Gold stocks went up 30, 40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices. But at least they're pricing out a crash now. People accept, okay, gold's going to be around this level, so we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the number one performing sector in the market this year, and they're hardly ever discussed. No one talks about them. I think Newmont Mining is the number one performing stock in the S&P 500. The only gold stock in the S&P 500, and it's beating all the tech stocks. Yet probably of all the stocks in the S&P 500, Newmont is probably the one that's the least owned.
Now, the last time I had you on, you told me that you think $100 silver is still too cheap. We've now broken out above $40. And to get back to the 1980 $50 high adjusted for inflation, silver would need to be nearly $200 an ounce. Is that a realistic target in your view? And if so, walk us through how you think we could get there.
Well, it's very realistic. I mean, especially if you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist.
What Schiff laid out in his first major point is the structural case for gold's next great leg higher. He reminds us that the previous bull market took gold from under $300 in 2001 to nearly $1,900 by 2011, a six-fold increase that was followed by more than a decade of sideways consolidation. That long base, built largely between $1,500 and $2,000, has now flipped from being resistance to acting as firm support. In his view, this sets up conditions for a symmetrical move of equal magnitude, which would imply gold prices reaching at least $12,000 per ounce if history rhymes. He ties this projection to today's deteriorating U.S. fiscal stance, weak labor market data, and the Federal Reserve's willingness to cut rates even as inflation remains above target, an unusual and risky policy combination that he argues will erode confidence in the dollar while boosting hard assets. From there, Schiff broadens his focus toward what he believes is the stealthiest opportunity in today's market: mining equities. While gold itself has been consolidating, mining stocks have surged 30 to 40% this year, outpacing the underlying metal and finally attracting more institutional attention after years of skepticism. Schiff stresses that the sector remains undervalued relative to spot gold, let alone to where gold could be headed if a debt or currency crisis unfolds. And he contrasts this with the speculative frenzy still surrounding Bitcoin, which has actually lost value against gold since 2021 despite relentless promotion, ETFs, and political support. For Schiff, this divergence signals that Wall Street and the public are still missing the bigger picture, which makes the entry point for gold and silver miners even more compelling.
I actually like the fact that this bull market isn't on anybody's radar, because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold. So maybe he's figuring out that Bitcoin is the wrong way to go. But, it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin. All the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the strategic Bitcoin reserve and the Bitcoin czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be. So we got a long way to go in the mining stocks. In fact, in April of this year, I kind of aggravated some of the guys at Schiff Gold because I put out this report that said the best way to buy gold, and it was to buy the gold mining stocks. And I was telling my clients for the first time not to buy gold. And gold was around 3,200, 3,300. And I said, look, I'm a gold bull. I love gold, but these gold stocks are so cheap that it doesn't make any sense to buy gold above ground. Just buy it while it's still in the ground because it's so cheap. And while gold went sideways for all those months, the gold stocks were soaring. And they're not as cheap as they were, obviously, but they're still very cheap. And I still think people should be buying gold stocks and gold now, and physical silver.
What do you make of this significant and rapid drop in the USD versus gold? And do you think governments will eventually be forced to reintroduce gold to the monetary system in one form or another?
Well, I think that is going to happen. I think it's pretty clear. If you look at the main buyers of gold the past couple of years, it's been foreign central banks. Why are they doing that? I think they're preparing to replace their dollars with gold. I think gold is going to become the primary reserve asset for central banks. And that's going to be a game changer for the United States because the world is not going to need our dollars anymore. Well, if they don't need our dollars, then how are we going to buy all the stuff that we need? Because we don't produce it. And how are we going to finance our debt? Because we've been relying on foreigners to finance that debt because they have the savings that we lack. So it's a big problem for the U.S. But I think from a monetary perspective, you're going to see, I think, people utilizing gold using the technology that exists today, whether it's on-chain with, tokenized versions of gold, or whether it's just through proprietary closed systems where the custodian has the gold and just uses technology to allocate ownership digitally so that people can transact business, receive and make payments, send money and receive money using gold, right? Just like using PayPal or Venmo or any other, Zelle or any of these things. You can just use gold. You don't have to transfer your gold. If I wanted to buy something from you and you wanted me to pay you, a gram of gold for it, right? Whatever that is, 30, 40 bucks, whatever, right? I don't have to send you a little bit of gold in an envelope and mail it to you. If the gold is held in a custodian and I have it tokenized in my wallet, I can just email or text you the gram. And now the ownership of the gold goes from me to you. So now you own the gold, not me anymore. You've got it. It's in a vault. Now, if you want the gold, you can have them ship it to you. But why do that? Just hold on to the ownership receipt, because now if you want to buy something, you can pay with gold because the guy that wants to sell you that, he wants gold too. Why would people prefer gold to dollars? Because gold holds its value. Why would I want dollars when I can have gold? It's like, why use the post office when I can send something by FedEx, right? The free market has provided me with a better alternative than the government, right? Why do people use Uber and Lyft? Because taxis are too expensive. Why are taxis expensive? Because the government provides the licenses and regulates them, and so they're expensive. The free market alternative is, well, I'll just call an Uber, right? So the equivalent of an Uber in the monetary system is gold, right? Gold is the free market's money. Fiat is government money, and it's lousy because it loses its value. The longer you hold it, the less it's worth. The opposite is true of gold. The longer you hold your gold, the more it's worth. So given a choice, which would you hold?
Pulling everything together, Schiff's argument is straightforward yet striking in its implications. Silver, once it breaks the $50 double top ceiling, could double to $100 in a matter of months, while gold is on track for a multi-year surge that could ultimately reset the way the world thinks about money itself. The most powerful buyers in the market right now are foreign central banks, steadily swapping out US dollars for bullion in preparation for a monetary order where gold resumes its role as the primary reserve asset. Should that process accelerate, it would directly threaten America's ability to finance deficits cheaply and import goods with printed dollars, shifting the balance of power in global trade and finance. For investors and observers alike, the takeaway is clear. These moves in gold and silver are not just about commodity cycles. They reflect deeper stresses in the world's monetary architecture. Schiff's forecast may sound aggressive, but it is grounded in historical precedent, supply-demand dynamics, and policy missteps that are already unfolding in plain sight. Whether or not gold ultimately reaches $12,000 or silver crosses $200, the structural drivers he outlines, debt, inflation, weak growth, and central bank diversification, are undeniable forces shaping the future of markets. If you found this analysis valuable, make sure to like this video, subscribe to the channel, and drop a comment below with your thoughts on where gold and silver are headed next. Do you think Schiff's predictions will come true, or is the market still underestimating the dollar's staying power? We'd love to hear your perspective. Thanks for watching, and stay tuned for more in-depth market coverage and expert interviews.